So let's first have a brief overview of what the topic is about. So in the curriculum, in the introduction, they have made a very interesting remark about this. Okay, so what they say is that this reading examines the results of revolution in the fixed income portfolio management over the period of times. Okay, so again the discussion goes like this, that for years and years there have been continuous improvements about how fixed income portfolio should be managed. There has been tremendous level of mathematical development in terms of building various portfolios. So in this topic, we don't have to study those tools. We don't have to go into nitty-gritties of how the calculations are done, but we have to study what are those tools and how they are put to use. And to just build an overall understanding, I have picked a fact sheet of one of the big index of in US. So this is your Citigroup Fixed Income Index, or also called US Big. This is a US broad market investment grade bond index, US Big. It tracks the performance of US dollar denominated bonds in the US investment grade bond market. Introduced in 1985, it includes US Treasury, government sponsored collateralized corporate debt, providing a reliable representation of US investment grade bond market. Sub indices are available in different categories. Now the most interesting thing that you would observe here is the number of issues, 6496. What does it mean? Number of issues 6496. What does this number imply? Constituents of the index. So constituents of the index are roughly 6500, which means any fund manager who's trying to use a passive investment management strategy replicating the index, he would be required to buy all the 6500 securities, and of course that's going to be difficult for two reasons. One, that the transaction cost is going to be really high, and second, there is a possibility that some of the securities might be very illiquid and therefore difficult to buy, right? So what are the techniques that we can use to overcome these kind of difficulties? This is what the topic is about. Now see the constitution carefully. This is based on the maturity, 1 to 3 years, 3 to 7 years, 7 to 10 years, 10 plus years, and this is based on the type of securities which are being invested. Now in this case, about, have they given in percentage anywhere? Yes, about 37% of the constitution is in US Treasury, 4% into government sponsored, 28% into collateralized, right? So different mortgage backed, asset backed securities that we studied at level 2, and roughly 30% into different category of trade investment vehicles. So let's start with the topic directly then. The first point of discussion is use of liabilities as a benchmark and use of bond index as a benchmark. Okay, so let's say you're a fixed income portfolio manager and you have a portfolio of about $500 million to be managed. The reason why you need a benchmark, because let's say you have been able to earn a return of 6% this year, but you do not know whether that 6% is a good return or not so good return, because that needs to be compared with someone, and then that comparison is a benchmark, right? So we can have two possible scenarios. Think of in fund manager of mutual fund. Does a mutual fund manager have a prerequisite liability to be taken care of? No, he doesn't have a liability, and therefore in case of mutual fund manager, typically the benchmark would be a bond index. He would say that US Big is the benchmark. US Big has been able to earn a return of 6%. I have earned 8%. I have a positive alpha of 2%. But as against, think of a fund manager who's managing a defined benefit obligation liability, right? Someone who's managing the pension fund account. He doesn't care about how much US Big is going to earn. His primary responsibility is to make sure he is going to earn sufficient so the liabilities are taken care of. That means either a liability would be a benchmark or a bond index would be a benchmark. Are we fine with this? Okay, so first point of discussion, and we've repeatedly gone through this in level 1 and level 2. What is the framework for managing portfolio? Point number 1, setting investment objectives with related constraints, developing and implementing the strategy, monitoring the portfolio, and continuously rebalancing or adjusting the portfolio. So please write down these 4 points. Framework for fixed income portfolio management. Later on each of this point, we would be having tremendous amount of discussion with different topics. Are we done writing? Okay. Let's see the next point then. Use of bond index as a benchmark. A manager might manage a bond fund that mimics a well-diversified bond index. Manager could follow either a passive strategy or active strategy. A passive would mean that he's simply investing into the exact constituent securities in the same proportion. And active means he's trying to tilt, either have higher proportion in certain segment or lesser proportion. So if you're a fund manager and your opinion is that all the securities are being valued correctly, then of course the strategy you would use is passive. But if you feel that you can identify some overvalued or undervalued securities, then the management strategy would be active. A manager mostly agrees with the market, then the management strategy is passive. They will construct a portfolio that mimics the index along with several dimensions of risk, and the return on the portfolio should track the return on the index fairly closely. An active management approach, the manager constructs the portfolio to resemble index in many ways, but through various active management strategies hopes to consistently outperform the index. Are we fine here? Usage of liability is a benchmark. The investment objectives when managing a bond against a single liability or set of liabilities is to maintain sufficient portfolio value to meet liabilities. Okay. So now remember this. In case if you're using index as a benchmark, your target would be to meet the percentage returns which are earned by the index. But in case if you're using liability as a benchmark, then the objective would be to meet the cash flow requirement of the liability. Are we okay here? Please try to answer this. Yes, straightforward, it is equal to or superior to the index. Difference between objective for a liability based benchmark and index based benchmark. If bond index is chosen as a benchmark, yes, if the bond index is chosen as a benchmark, then the objective is primarily return oriented. Javed, is it fine? If a bond portfolio manager specifies liability as a benchmark, she is attempting to earn a return that is, oh come on, same. Yes, it is equal to or higher than the return promised to the liability holders, whose objective is to replicate the performance of an index, specify the benchmark as a bond index. Okay then. So next LOS in point of discussion. These are the 5 separate investment strategies that we would be looking at. We will try to understand what is a pure bond indexing. Then we will also understand what is enhanced indexing, matching, primary risk factors, enhanced indexing, minor risk factor mismatches, larger risk factor mismatches, and full-blown active. Okay. Now the ones that you see in green here, these are the passive investment strategies. Okay, but within passive, this will have a highest amount of tilt, the last one, and this would be exactly similar to what the bond index is. And the last two, which are in red, these are the active management strategies. Now, how did it come from? So in curriculum, they've given reference to this gentleman, and then I read quite a lot of stuff about him on the internet. So this is an important stuff. He currently is working with Vanguard, and he's the one who wrote this topic and came up with this idea. So we'll just read his profile a bit. Okay, of course, and the important point is mentioned here. So he's a principal, senior portfolio manager, head of taxable bond group at Vanguard, oversees index and active taxable bond committee of Vanguard Index, instrumental in developing global bond index fund lineup of okay blah blah blah. But I think this is where the whole stuff comes from. He has written two widely published chapters on fixed income management and has testified about transparency into this. So one of the topic that we are studying is coming directly from this gentleman here. Okay, and he's the one who's categorized into those 5 separate segments. So now we'll go through this table to understand each one of them. Okay, first one is pure bond indexing. A pure bond indexing is a bond indexing. It is purely a passive strategy. Now what you're doing in this strategy is that you are trying to replicate the cash flows or replicate the securities in the index exactly as it is. That means if someone is following this strategy on US BIC, then he would buy all the 6,496 securities in the same proportion. Of course, now the only difficulty is that this entire index would be worth maybe thousands of billions of dollars, right? Where a fund manager might have few billion of dollars with him, and therefore he might able to find it difficult to buy certain securities which are relatively illiquid. So what are the advantages and disadvantages of the first one? Return before expenses tracks the index. Do you agree? Yes, because you are buying securities in the same proportion. So removing the expenses part, it is going to track it exactly. Same risk factor exposures as the index. Low advisory and administrative fees. And why is this low? Because he's not using his brains, he's just replicating the portfolio. Costly and difficult to implement, and lower expected return than the index. Okay, and why is lower expected return? Transaction cost, which index does not have a transaction cost, but his portfolio will. Now to overcome these difficulties, okay, so we'll first finish this slide and then you write. To overcome these difficulties, what you can do is maybe use a slightly smarter approach by using the second method, which is enhanced indexing, but allowing the small or matching the primary risk factors. Okay, so the best way to remember this strategy is simply remember that this is nothing but sampling. Okay, now the sampling process could be really complicated, but in a nutshell what you're trying to do is that you try to sample your database on certain set of stratas. So divide your constituent securities into treasury securities, the way we saw some time back, or into commercial securities or credit securities, agency securities, and buy in the same proportion. So this is one type of strata. Or see what is the duration of the original index. For example, in original index, 3-year securities are about 30% weight, 5-year securities have about 20% weight, and then let's say 10-year securities have remaining weight. Right? So not only match the type of securities purchased, but also try to match duration. And therefore in real life this could be a really complicated process, because you have to ensure that you are also keeping your exposure to multiple risk factors exactly same. And what method they use here is called as cell matching. Okay, again there are sophisticated softwares available to do that, but cell matching means creating multiple cells in such a way that your proportion is exactly same. What are the advantages here? Less costly to implement, less costly in terms of transaction cost, increased expected return. Why? No, your risk factors are same, but compared to the earlier strategy now, you would have better returns because you will have lesser amount of transaction cost. Maintain exposures to index primary risk factors. So remember this point. We are going to maintain the same duration, but we are also going to ensure that risk factors are same. We are not going to let it change in this strategy. Increased management fee, reduced ability to track index, and lower expected return on index. That means we have both. Lower expected return because we have a lower transaction cost, but what we have is a increased management fee. So there are two effects working in the opposite direction. Okay. Now the third strategy, and the second one, just remember this as sampling, matching primary risk factors. The third one is small risk factor mismatches. Again, in this, the large risk factor, which is duration, that has to be same as overall index. But now you can take smaller exposure. Maybe you might take more exposure to credit or more exposure to treasury. So increased expected return, reduced manager restrictions, increased risk, increased tracking error, and increased management fee. Is it fine? So now all the three are passive investment strategy. Quickly write down advantages and disadvantages. On the exam you might be required to write them as it is. Okay. So write down the same set. If you've written this in the past, write it again. Also see if you can remember these points. Yes, is it done? Do it fast. Okay, so in all the three strategies, your duration is exactly, in fact, in this case, it has to be. Even in this strategy, your duration is same as index. Is it done, Bhupendra? The way to ensure that we pass level 3 is to write as much as possible every day. Okay, so I am going to make you write every week, but I think on your own also you have to put in at least 30 to 40 minutes a day writing. Should we move on? Finding difficult to keep up speed, Vishal. Okay, let's go next one. Now the next two are the active strategies. Active management by large risk factor mismatches. Okay, don't get confused. Here the risk factors were same. We were matching the primary risk factors. It was only a sampling strategy. Here we allowed to let them change by a small margin. Now how much is small, how much is large, that's not defined. But we allowed them to change by some amount. Here we are allowing them to change by a larger amount, and therefore now it becomes a active strategy. Returns, of course, you will expect more. Manager doesn't have a restriction anymore. And ability to tune the portfolio duration, which means now your duration need not be exactly same as the duration of the index. Okay, it might be more, it might be less. Higher risk, higher tracking error. So in fact, if you would see these points, these are same for the last three strategies. Higher risk, higher tracking error, and increased management fee. And then the last one is full-blown active, right? So again, higher return, no restrictions, and no limits on duration. Are we fine with this? So quickly write these points. Yeah, maybe on the disadvantage side, if you're tired of writing, just save time. But on the advantage side, at least write them. And make sure you remember as much as possible. If I were you, I will decide what pen I'm going to use on the final exam, and maybe use the same pen for all 6 months, so that you are better equipped and well practiced. Decide what kind of pen you would use on the actual examinations. Whenever you write, pen, and then use the same pen. Yes, yes. Afternoon is OMR, so you do whatever you want. You can. Yeah, people just, yeah, the OMR is you OMR you use pencil, but yeah, taking purpose, or yeah, correct. But I agree, pencil. Should we move on? Previous one. Increased, decreased expected return. Yes. No, but you're saying, do you have a reservation on this point? Uh-huh. You're saying that no, it could be. It's both ways. It's both ways here. See, because there is a trade-off of management fee and there's a trade-off of transaction fee, right? So there is a possibility that in some cases management fee might be higher than the benefit we have of transaction fee, so lower expected return. Or in some case the benefit of transaction fee is higher and therefore higher expected. So it could be both side. And I think this point you people can use on both all the portfolios which are not pure bond indexing. Okay, so this is something which is a common point. These points are relatively easier to remember. Risk increases, tracking error increases, and management fee increases. So try to remember these points, because if required you should be able to write them as it is. Should we move on? Yeah, please try to answer a few of them. Minor risk factor mismatches, is it first, second, or third? Third one. Yeah, it's very. Is it an active strategy? No, it's a passive one. The first three are passive, the last two are active. So A is not the answer. Now it's a stupid option in a way, because if the strategy is minor, it cannot be larger mismatches. So of course the answer in this case is C. What is the answer? C. Because pure bond indexing, we are exactly replicating what is there in a bond portfolio. Yes, Javed. Active management and is aggressive with large mismatches in the risk factor. Which one? Yes, which one? B. Because maybe it says it's aggressive and it's completely active. So in this case, of course, this is also active, but then this is a completely active strategy. So we go with this. Should we move on? Yes, Gail. C. Bhupendra. B. How many of you feel C? C is the answer. Yes. See, if the return on the bond portfolio is substantially higher, not necessarily the tracking error is small, because tracking error simply means the difference between the index return and the actual return. So this is not the answer. Tracking error refers to how closely return matches market expectation, no, matches the returns on index. But yes, C in this case was correct. If they are closely matching each other, then it is close to 0 or small. Should we go ahead? Matching primary risk factor. Is it first, second, or third? Second. Pure bond indexing is the first one. This is a second strategy, which is similar to. No, yeah, you answer the question first. What is the answer here? A, yes. It uses a sampling technique to reduce transaction cost. Okay, then next LOS. What is the criteria we should use while selection of benchmark bond index and selection of specific index given the description of investors' risk aversion, income needs, and liabilities? Okay, this is one of those questions where I feel there is a high probability of you being required to write in the morning section. Okay, because there's a lot of juice, and these are the kind of questions which have been tested in the past. In fact, there is one in the previous exam questions. Criteria for selection of benchmark bond index. What do you think would be the criteria? If you are a fixed income fund manager and you want to select an index, right? So on what basis you will try to select the index? If you're selecting an index, that means it's not a liability. So based on investors' risk appetite, right? How much credit risk he is willing to take, different risk. So one factor is going to be how much credit risk he is willing to absorb. What else? Expected income, yes. What are his cash flow requirements? So These are the primary two factors that we would look at. Now read this part carefully. When would you resort to active management? Only when the client's objective and constraints permit and manager's ability to justify it. Okay, this is your active management. And on what basis you will select the appropriate index? First thing that you will check is market value risk. If your client is not willing to take risk, then you will select the index which has got lower market value risk, or vice versa. And then it says that longer the maturity, more is the risk. Do you agree? Yes, because longer maturity means higher duration, and higher duration means more sensitivity to changes in price. Second factor is income risk. Longer the maturity, less is the risk. Do you agree with this, Vipul? Why? There is a risk of reinvestment. Longer the maturity, higher is the risk of reinvestment. Yes, the cash flow is locked in. If you're investing in a 20-year bond, you know what is the amount of coupon you're going to receive. And if your client has an income need, then he's not going to reinvest. He needs that money, so he's going to withdraw that and maybe consume that, isn't it? So longer the maturity, lesser is the risk. These 2 points you need to know. Higher maturity, higher credit risk, but higher maturity, lower income risk. Now, what they have done is, in the curriculum there is an example given where they said these are the three indexes, okay, with different characteristics, and this is a client. Okay, he is willing to take very less amount of credit risk. Then which index will you choose for him? And the answer would be the one which has got lowest amount of duration, because lowest credit risk. Then there is one more client who has a very high level of income need. Then which index will we choose? The one which has got longer maturity. Following this? Interest rate risk. Credit risk is the third point. So credit risk, match it with the benchmark. So if your client is not willing to take much of a risk, get into investment grade bonds, so on and so forth. And the last one is liability framework risk. This is applicable only when the bonds are managed using a liability as a benchmark. And then you have to ensure that you are generating sufficient cash flows to meet liability. Not being able to generate sufficient cash flow to meet liability is called liability framework risk. Are we fine with this? So write down quickly. यहाँ पे heading दो, write this as a separate box, the red one, and then give a heading, issues to be considered while selecting a benchmark. While selecting a benchmark. I don't know with my handwriting how I managed to pass level 3. Issues to be considered while selecting a benchmark. Are we done? Done writing? Okay, please answer this. Yes, in terms of the structure of the liability. NBFC. Will it be C? Yes, C would be correct, because the typical business model for an NBFC would be to borrow and then invest into different structures. So they'll have to ensure that whatever is the liability, their investments generate sufficient cash to take care of those liabilities. Defined pension plan, again in terms of liability. If it was a mutual fund, then it would be in terms of a bond index. Okay. Now next few points of discussion. The concept of duration matching, use of key rate durations, and use of key rate duration to align the risk exposure of portfolio with those of the benchmark bond index. Now a quick revision of what we have learnt of duration so far. We know that there is something called as a Macaulay's duration, and Macaulay's duration is simply a cash flow weighted, a discounted cash flow weighted maturity. Is that correct? Discounted cash flow weighted maturity. Now next version of the duration is the modified duration. The formula for modified duration is V minus V plus divided by 2 into V0 into delta Y. In case of modified duration, we know that it works only, in fact all the durations, they work only when there is a parallel shift in the yield curve. Do you agree with this? What is the meaning of parallel shift in the yield curve? That all the maturities interest rate or yields either increase by the same proportion or decrease by the same proportion. Also, a modified duration captures only the linear relationship between the interest rate and the bond price. But we know that in real life that relationship is non-linear and that effect is captured by convexity. The next type of duration is effective duration. Effective duration is typically used for bonds with embedded options because it considers the optionality of the bond. And again the formula for effective duration, V minus V plus divided by 2 into V0 into delta yield curve. Okay, so delta yield curve, because effective duration captures the difference of entire yield curve. You know, at level 2 we have understood that if it's a callable bond, we have to use a binomial model to value it, right? And there's a possibility that at certain nodes bond might be called back, and that effect is captured into effective duration. Then we have, do you want to write this? Yes, no? Okay. Then we have the concept of convexity. We know it was the second derivative of the relationship. The formula was V minus plus V plus minus 2V0 divided by V0 into delta Y square. At certain places they also write 2 in the denominator, at certain places they do not. Okay, if they write 2 here, we don't have to write 1 by 2 again when we are using the impact of changes in interest rate using duration and convexity approach. Remember this, duration into delta Y plus convexity into delta Y square. So if you've written 2 here in the denominator, you need not say divided by 2 there. And if you've not done 2 here, then we will have to say convexity into delta Y square into 1 by 2. So this is your convexity. Next concept is dollar duration. Okay, the idea of dollar duration is to find out that if the interest rate changes, by what dollar the value of the bond portfolio is going to change, dollar duration. So typically we calculate this as portfolio value into whatever is the duration of that particular bond, and typically we calculate dollar duration for 1%, 100 basis points, so this would be 1%. Is that fine? So this is your dollar duration. Then there is a concept of key rate duration. Can you tell me what would be key rate duration? What is key rate duration? Okay. Now see this carefully. Maybe this, if you write this, it will help. Let us say this is your yield curve. What do we have on the x-axis? Maturity. What do we have on y-axis? Yields. Let us say as of now the yield curve is somewhat like this. Okay. Now the yield curve is changing, and when the yield curve is changing, if it changes exactly in this fashion, assuming that this is exactly parallel to this curve, we will say that this is a parallel shift. A parallel shift in the yield curve. What does it mean? It means originally, if this is maturity of year 1, let's say this is interest rate 3%. Maturity year 2, interest rate was hypothetical 4%. When the yield curve has shifted upward, now 1 year maturity will have interest rate of 4, original 3 plus 1. 2 year maturity will have an interest rate of 5, 4 plus 1. An assumption that YTM of every maturity has increased exactly by 1. This we call as a parallel shift in the yield curve. But we know that in most of the cases in real life, it is not parallel. Okay, again, let's say this is your yield curve. What if the new yield curve, assume this to be a straight line, is somewhat like this? Or what if this is your yield curve, and what is the new yield curve is somewhat like this? Then what we say is that this is a twist in the yield curve. Okay, so know this is twist, and this is also twist in the yield curve. And what kind of a twist is this one? A flattening one, because your new yield curve is kind of becoming more flatter, and this kind of a twist in the yield curve is a steepening one, steepening shift. So please write down these. Now we are going to integrate this with key rate duration to understand why twists and shifts are parallel important. Will you be able to distinguish between flattening and steepening? Okay. Now let's say we have a portfolio of bonds made of multiple securities. Let's say security A, security B, C and D. Let us say market value of these bonds is 100, 150, 200, so that's 350, 450, let's say 50. Total market value of 500. Now we will have duration, or let me have maturity of each of the bond, and let's have duration of each of the bond. Let's say maturity is 3 years, 5 years, 10 years and 20 years. Duration of each of the bond, so let's say duration of this bond is 2, duration of this bond is 4, I'm just making it up, duration is 7, let's say duration is 14. We can calculate a portfolio duration. How can we calculate a portfolio duration? Multiply the weight with the individual duration. So this weight is going to be 20%, this weight is 30%, this weight is 40%, this weight is 10%. This would be 0.4, this would be 1.2, this would be 2.8, and this would be 1.4. Let's add them up. This is 1.6, 2, 3, 5.8. So 5.8 is the duration of the entire portfolio. Okay. What is the implication of 5.8? If interest rate change by 1%, the value of the entire bond portfolio will decrease by 5.8. But now the question is, interest rate change by 1%, 1% for which maturity? 1% for year 3, 3-year YTM, or 1% for 5-year YTM, 1% for 10-year YTM, or 20-year YTM? Which one? Are you following what I'm trying to say here? That if interest rate changes by 1%, portfolio value will decrease by 5.8%. But then when we say interest rate changes by 1%, for which maturity? What do you think? Now, will it change for the 20th? Are we looking at the 20th year maturity, or 3rd year maturity, or 5th, or the center 7.5, or average of these? Which year? All the years. That means if you have a portfolio duration, and if you have immunized your portfolio to this duration, it works only for the parallel shift in the portfolio, or parallel shift in the yield curve. So this 5.8 is true if and only if there is a parallel shift. Otherwise it is not going to work. So write down this and then write down one sentence after this. Heading in your notes would be portfolio duration. Are we done here? Write down a sentence. A portfolio duration is the weighted average of duration of constituent bonds in the portfolio. Okay, a point below that. Portfolio duration works effectively only in case of parallel shifts in the yield curve. Okay, below that, however it is a ineffective measure of risk for twist in the yield curve, which means if 1 year, so let's say 3-year interest rate increases by 1%, but 5-year increases only by 0.5, and 20-year increases only by 0.2. In that case, the bond portfolio is not going to change by 5.8. So then what we do is that for your constituent security, so again you have a portfolio, let's say XYZ, we calculate a key rate duration. Okay, so let's say a key rate duration here is 1.7, a key rate duration here is 2.1, and let's say these are maturities. So maturity of 5 years, 10 years and 15 or 20 years. And let's say a key rate duration is 6. Now what is the use of key rate duration? Now we know that if 5-year YTM changes by positive 1%, 10-year YTM changes by positive 0.5%, and let's say 20-year YTM changes by positive 0.25%. Right, now it is a twist in the yield curve, different maturities are changing at different rate. Then we can find out the impact on value of portfolio. Impact on value of portfolio. So then 1.7 into 1, this would be minus 1.7%. 2.1 into 0.5, this would be minus 1.05%. And 6 into 0.25, this would be minus 1.5%. So that's 2.2, 3.25 is the net impact of change in the value of bond portfolio. This is how key rate durations are put to use. Is the calculation correct? Yeah, this should be 4.25. 4.25 is the change in the value of bond portfolio. Are we okay? So write down this example. Do you want me to explain this again, or is this clear, Glenn? So if you want to effectively manage the duration of your portfolio, then the best way to manage or immunize yourself is to ensure that you are hedged against each of the key rates rather than managing the overall duration. Because if you hedged against each of the key rates, then irrespective of twist in the yield curve, you would still be able to effectively hedge risk of your portfolio. Is that clear? Now we'll take